In recent years, China has made a significant change in where it gets its oil. Instead of buying a lot from the United States, China is now sourcing more oil from other countries, especially those in the BRICS group. This shift is part of China's plan to have a more stable and diversified energy supply while building stronger relationships with these emerging economies. So why is China doing this? One big reason is the political tension and trade issues with the United States, and tariffs that make it risky for China to rely heavily on American oil. By buying oil from many different countries, China reduces the risk of being affected by problems with any single supplier. It's like having multiple backup plans so that if one fails, there are still others to rely on. Furthermore, with US sanctions on various countries, and companies involved in the oil trade make it harder for China to do business smoothly. So China looks for more stable and reliable partners in the global south. Another interesting point is that trading with countries in the global south often uses other currencies instead of US dollars. This helps China move away from depending too much on the US dollar, which is a big deal in international trade. In 2023, China imported oil from over 100 countries. However, the top 5 suppliers were Russia, Saudi Arabia, Malaysia, Iraq, and the United Arab Emirates, UAE. These countries played a huge role in meeting China's oil needs. Russia became China's largest oil supplier in 2023, providing 18.3% of China's total oil imports, which was worth about $94 billion. This means China was getting around 2.1 million barrels of oil per day from Russia. The strong energy partnership between China and Russia has grown even more because of global geopolitical tensions and sanctions affecting Russia's other export markets. Saudi Arabia. The second largest supplier was Saudi Arabia, contributing 10.7% of China's total oil imports, worth about $55 billion. Despite increasing its crude shipments to China, Saudi Arabia's market share slightly decreased due to competition from Russia. However, Saudi Arabia plans to boost its oil supplies to China in 2024 with new contracts, aiming to compete effectively with Russia. Malaysia provided 8.8% of China's oil imports, totaling $45.5 billion. Its strategic location and competitive pricing have made it an important supplier. The volume of oil imports from Malaysia is expected to stay stable or grow in 2024 due to strong trade relationships and investments in infrastructure that support energy trade. Iraq supplied 6.9% of China's oil in 2023, amounting to $35.4 billion. Iraq's large oil reserves and lower production costs make it an attractive source for China. Imports from Iraq are projected to continue at high levels in 2024, supported by investments and agreements between Chinese companies and Iraqi oil producers. United Arab Emirates, UAE. The UAE provided 6.6% of China's oil imports, totaling $34 billion. The volume from the UAE was about 480,000 barrels per day, reflecting a 40% increase from previous years. The UAE's strategic investments in energy infrastructure and refining capacity in China have strengthened its position as a key supplier. In 2024, the UAE is expected to maintain or increase its oil supplies to China due to robust trade relations and new long-term agreements. This change in China's oil sourcing has several effects on the United States. The U.S. oil industry might lose money because China is buying less American oil. This can lead to decreased profitability, potential job losses, and lower investment in the U.S. oil sector. The U.S. also loses some of its influence as a major energy supplier. Being a key supplier to one of the world's largest economies is significant, and losing this status can impact U.S. strategic interests globally. If China buys less U.S. oil, the price of oil in the U.S. might drop. While lower prices are good for consumers, they can hurt U.S. oil producers and related industries, causing economic disruptions in regions that depend on oil. Additionally, oil trade has traditionally used U.S. dollars, reinforcing the currency's global dominance. If countries start using other currencies for oil transactions, the demand for the dollar could decrease, affecting its value. This shift is evident as China's use of its currency, the renminbi, RMB, in international payments has increased significantly, surpassing the U.S. dollar for the first time in March 2023. China's move to use fewer U.S. dollars in trade is part of a broader strategy to support a more diverse global economy. The diversification of currencies in international trade could lead to a depreciation of the U.S. dollar. This could create inflationary pressures in the U.S. by raising the cost of imports and could reduce foreign investment in U.S. assets, potentially leading to higher borrowing costs. In summary, China's shift in oil buying habits from the U.S. to other countries like Russia and Saudi Arabia aims for more security and less dependency on any single country. This change has significant impacts on the U.S. economy and the global role of the U.S. dollar. China's pivot to the global south and BRICS nations for oil imports is not just about energy security, but also part of a larger strategy to create a more multipolar global economic system, reducing dependency on Western financial systems and enhancing regional economic integration. Thank you for making it this far. If you like this video, you might like our next video, the 3 strategies of the BRICS. Thank you, and as always, stay blessed.